One more day, 30 minutes until the start of the cash trade as we wait for tariffs. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
And coming up, frustration and fatigue hit Wall Street. Investors are bracing for Trump's tariff rollout, the biggest risk confronting investors in years.
Meanwhile, automakers make a last-ditch effort to sway the Trump administration on those planned tariffs. This hour, we're also going to get sales for the automakers rolling in.
Plus, Howard Lutnick puts chip grants in limbo. The Commerce chief may withhold funding to push chip makers to expand their U.S. projects. All that and more coming up, but let's take a look under the hood at some stocks moving ahead of the opening bell. We start with Tesla rebounding a little bit ahead of those quarterly delivery numbers. We're expecting those out tomorrow. At the same time, Chinese rival BYD reported that sales were up 58% in the first quarter versus last year. Other automakers released sales data this hour.
And I'm looking here, Katie, at Vivid Seats, taking a hit this morning to the tune about almost 3.4%. President Trump's executive order to crack down on ticket scalpers, junk fees, and price transparency is moving them and their rivals.
I'm watching Johnson & Johnson after a judge rejected its third attempt to use bankruptcy as part of its talc cancer settlement. Separately, President Trump is planning tariffs aimed at the pharmaceutical industry, which has been protected for 3 decades by WTO rules. And the president is set to unveil his global tariff plan tomorrow in the White House Rose Garden. The extent of his levies remain unclear, and he's offering few clues ahead of the reveal.
They're reciprocal. So whatever they charge us, we charge them, but we're being nicer than they were. The numbers will be lower than what they've been charging us, and in some cases maybe substantially lower, but we sort of have a world obligation perhaps. But we're going to be very nice. Relatively speaking, we're going to be very kind.
And for the latest details, we're going to bring in Bloomberg White House reporter Skylar Woodhouse joining us now from Washington. You have the automakers trying to make a last-ditch effort to really roll back some of these threats. You have Trump aides coming to the surface with fresh proposals. What is the mood in Washington before this Rose Garden address?
Good morning. There's a lot of chaos going on right now in Washington. I mean, there's always something happening in Washington, but right now, the day before Liberation Day, as President Trump has been calling it, all of the different trade groups, officials, lobbyists, everyone is trying to make their final pitch to the White House, really, as they, sort of determine what the final plan for these tariffs are going to look like. Now, we've been hearing about these tariffs for a very long time now, and we are finally at the April 2nd marking point. And basically what we're going to see is, all right, are there going to be any 11th hour deals where maybe one group is exempt from these tariffs, or maybe one group gets higher tariffs? There's so much going on right now as folks look to try and lock down what really will happen tomorrow in the Rose Garden.
It seems as though the president's pretty clear that he wants to put on reciprocal tariffs that are as much as, but a little bit lower than the tariffs others charge us. Can we take him at his word on that?
I think with President Trump, you never know what you're going to get until he is at the microphone speaking. And I mean, we've seen with President Trump, we might think that one thing is coming down the pipeline and we see a Truth Social post that it is completely different from what maybe we were expecting. So I think the president, he's been swaying back and forth on this. We've heard that, maybe he would be more conservative, that he'll be more generous, but also maybe that things could be a little bit higher. So we really are on this swing right now as things sort of fluctuate to see where do we exactly land. Are we landing on the higher end or are we landing on the lower end? So it's only a matter of time until we see what the deal actually is.
Indeed, the countdown is on. Skylar Woodhouse, appreciate your reporting. And tune into Balance of Power for special coverage of President Trump's Rose Garden announcement on tariffs. Guests for today's special include former USTR Catherine Tai. Balance of Power will have extended programming today and tomorrow from 5 to 7 p.m. New York time. Meanwhile, Commerce Secretary Howard Lutnick is signaling that he could withhold promised CHIPS Act grants. Bloomberg sources say that Lutnick is pushing companies to substantially expand their U.S. investments. For more now, we're joined by Mandeep Singh. He is senior tech analyst for Bloomberg Intelligence. And Mandeep, of course, TSMC, their $100 billion investment pledge comes to mind. Are we likely to see more commitments of that type? Is this gambit going to work?
Yeah, look, I mean, when you look at the size of CHIPS Act, it was like around 50 billion, and it was announced all before, this whole AI wave came. And one of the things that we are noticing is obviously, the likes of TSMC are spending more on their CapEx, Samsung as well. And what I think the administration seems to be doing is focusing on making sure that these companies commit a significant portion of their CapEx here in the United States. So this is all bargaining tactics in terms of, driving the size of investments, similar to, as you mentioned, for TSMC and Project Stargate. So I expect to hear, more announcements like that.
Well, how significant will it be in forcing these companies to put more money on the table, given that we've already seen so many announcements already, billions of dollars toward AI spend? In other words, is this a big enough stick to come to the table with from the Commerce Secretary?
I mean, when you think about the cost of, constructing a fab, it takes anywhere from, 20 to 25 billions to construct a leading node fab. Now expand that to the overall ecosystem. You need, logic, you need memory, you need advanced packaging. And that's where, the numbers get bigger and bigger because the size of this AI market, I mean, one company is almost $3 trillion in market cap. So we're talking much bigger numbers now. And that's why I'm not surprised to see that, even a CHIPS Act $50 billion subsidy means nothing. I mean, everyone is trying to think about bigger numbers, and that's where I think administration is going with this.
All right, Mandeep, thanks very much. Mandeep Singh there of Bloomberg Intelligence. Let's get to Intel now. The new CEO laying out priorities for the company, saying it will spin off non-essential assets to better align with customers and focus on retaining talent. Bloomberg Technology co-host Carolyn Hyde joins us now. So, Carolyn, Intel, obviously, one of the companies that would be most affected by any change in these chip grants.
Yeah, they're on tap to get about $8 billion was what was agreed with the Biden-Harris administration, but they were investing $100 billion into U.S. manufacturing. Of course, they want to be more in the fabrication area of things, but more broad investment in the semiconductor industry. Now, $100 billion is a big commitment. A lot of this not only is about the grants, but it is about that 25% tax credit as well, which is so crucial to these companies. Looks as though Lutnick, of course, is thinking about how to enhance that yet further. But at the moment, Lip Bhutan, yes, he's thinking about his investment. Yes, he's thinking about grants from the government. He's also thinking about his culture. He's thinking about his people. And actually, all the analysts out there liked what he painted at the Vision event that they just had in Vegas, because it's more right-sizing. It's not product roadmap. It's not big wishes. It's more under-promising, trying to say, I'm going to right-size on culture. I'm going to get the right talent in to take on the AI opportunity here.
Well, we talk about this so much. You have Intel, really an American treasure. If you have a lot of its rivals facing uncertainty, wouldn't that be even better for Intel while they're trying to make all of these big investments and maybe find some buyers for assets?
I think the real issue is right-sizing where they focus on from a product perspective, and they missed the AI trade. Gaudi, the offering they had, just didn't inject enough excitement in the market, and so everyone's still plowing into NVIDIA, maybe a little bit of AMD.
Gaudi is
their offering in terms of the accelerators, the AI accelerators that you can power forward in the data center offerings. They've got to get that on track. They've got to start thinking about their clients. This is what analysts want to see. How are they going to deliver to their clients when it comes to the foundry? And in many ways, some of these clients are indeed rivals. It's a frenemy organization out there. How are they going to be making chips for those rivals that at the moment are still in a quandary as to whether they're going to get chips funding too?
All right, Caroline, great stuff as always. Our thanks to Caroline Hyde, the co-host of Bloomberg Technology. Let's get a check on these markets right now. We have just over 20 minutes until the bells ring. We saw some window dressing at the quarter end yesterday. That lifted the S&P 500 out of its malaise, but you can see that we're right back to where we were, down about 0.3% on the big benchmark. Big tech also feeling the pressure, down about 0.2% on the NASDAQ 100. Also, the Russell 2000 off about 0.2%.
Now, Katie, I want to bring you some breaking news as well, because Macy's is naming ex-Capri executive Thomas Edwards as its new CFO and COO effective June 22nd. You're seeing Macy's shares on the rise to the tune of about 1.2% pre-market. Remember, Macy's is a stock that has been down by more than 25% this year already, and more than 15% last year as well, Matt.
All right, coming up, the auto industry makes a mad dash to persuade President Trump to temper tariffs. We take a look at their pitch to Washington next. This is Open Interest. Let's get now to high interest. Look at what's making headlines around the world. A federal judge is rejecting Johnson & Johnson's third attempt to shield itself from cancer-related claims related to baby power. The latest trust proposal would have set aside $9 billion per victim and used bankruptcy. Opponents say J&J should not be allowed to use Chapter 11 to resolve the cases and question the company's tactics in rounding up pre-bankruptcy support from victims. Brookfield Asset Management is agreeing to buy a majority stake in Angel Oak Companies. That's a mortgage lender, an investor that manages over $18 billion. The asset manager, Brookfield, will take a 50.1% stake in Angel Oak, offering its own investors access to the firm's residential mortgage credit business. Angel Oak will still operate independently. And China's BYD is posting a 58% gain in first quarter sales versus the same period last year. It's the nation's best-selling auto brand. It delivered 986,000 units in the first 3 months, of which 416,000 were pure electric vehicles. The numbers will likely be in stark contrast to U.S. rival Tesla, which only makes EVs and whose first quarter sales may be about 377,000, according to analysts' estimates. And staying on cars, Bloomberg is reporting exclusively that U.S. automakers are making a last-ditch effort to the Trump administration. They are hoping to get a tariff exclusion on certain low-cost car parts like electrical wiring, which are usually made in low-wage countries. For more, we are joined by one of the writers of that report, Bloomberg's David Welch, our bureau chief in Detroit. So, David, it looks like now components are going to be tariffed on top of the assembled vehicle tariff of 25%. Is there any thought that the Trump administration is willing to change that?
They might. There are a lot of discussions going on, top executives, government affairs executives, all talking to people in the Trump administration. What they want to do, they sort of want to kind of keep as much of the USMCA deal as possible. So with USMCA, if vehicles qualify the way the Trump administration has laid out the tariffs now, any non-U.S. content would get hit with a tariff. So you take something like a Chevy Silverado pickup truck made at the plant in Mexico. Probably half of that content is made in Mexico because the engines and transmissions are done down there, and other parts like wiring and stuff like that. So, that's a $50,000 truck. Half of that value, $25,000, would be hit with a 25% tariff. The automakers are looking for relief on that other part that would be hit with tariffs. Because otherwise, even if a vehicle qualifies for USMCA, it can get quite heavily taxed when it comes across the border, and then they have to try to pass that on to customers. And we have the same issue we would have with a vehicle that's made 100% in Mexico, Korea, anywhere else. It really makes even USMCA compliant vehicles in Mexico and Canada subject to very heavy tariffs.
Well, let's talk about the passing on of costs a little bit more. We heard from President Trump telling NBC over the weekend that, quote, he couldn't care less if they raise prices because people are going to start buying American cars. We're awaiting some of those delivery numbers, David. Are we expecting to see any of that pull forward behavior on the part of consumers?
Yeah, we'll probably see a fair bit of it. Just anecdotally, we've talked to a lot of consumers ourselves who've been kind of, in a mad scramble to buy vehicles before tariffs kick in. My mother called me last night and asked me if she should go ahead and do this. So I think it's happening in some, significant numbers. We'll see how much. And you probably won't know how much pull ahead there was until we look at sales in April, May, and June to see if they're down at all. But we're going to see some. We're definitely hearing that March was the strongest of the 3 months in the quarter. It traditionally is because the weather gets better and people actually go out and start kicking tires at dealerships. But all the data I'm seeing says it was a very strong March, and some people are definitely trying to head off tariffs and get out there and buy or lease while the getting is good.
I wonder why the big U.S. automakers, David, the big three, don't source more of their component parts in the U.S. Is it because they're internal combustion engines still for the most part? If we look at a chart of the average domestic content in U.S. vehicles, Tesla is able to source 81% of its component parts domestically, whereas Ford and GM only do 54%.
I don't think it has much to do with whether it's EV or internal combustion directly. Look, Tesla is a startup, and they vertically integrated a lot. They even make their own seats, which they didn't necessarily have to do. But I think a lot of the parts, batteries, engines, they do get battery components from overseas. But because it was a startup that had to kind of create their own ecosystem, their own supply chain in a lot of ways, I think Elon Musk's solution was always to look, if we can't find someone who knows how to do this quickly because it's relatively new, we'll do it ourselves. And I think also he didn't want to give some supplier a bunch of the profit margin. So they make a lot of their own stuff internally, and they're going to do it very close to their own factories because why deal with longer supply chains than you have to? I think when a company starts with a blank canvas like they did, you can do things like that. A lot of the components we're talking about that would be sourced in Mexico. It's wiring harnesses, very labor intensive. I talked to an executive at a major seat manufacturer yesterday who said stuff like cut and sew, right, for seat leathers and seat fabrics. That's very high intense, low value add, heavy labor kind of stuff. You have people stitching and sewing seat parts. Those are done in Mexico, and then because the wages are cheap, and then they ship them up to the U.S. and actually make the seat out of it. It's stuff like that.
David, I want to also point out we are getting some of the data out from the car makers via Ford, saying that overall retail sales rose 5% in the first quarter. March results drove a lot of that. It increased 19%. They're speaking to the sales of the F-Series growing 24%, and electrified vehicle sales totaling a record actually for Ford of 73,600, a little more than that in the first quarter, which is up 26%. I know we're looking through the numbers. You're talking to us here. But what do those numbers signal to you, especially ahead of more Tesla data tomorrow with the electrified sales?
So two things. With a strong March like that, that tells you that there probably was a good sized group of people going out and buying vehicles in anticipation of April tariffs. People read the news and they don't want to pay thousands more per vehicle. On the EV side of it, we saw it in the fourth quarter where people were worried about the tax credits going away, so they went out and bought. I think you might be seeing a second wave of that in the first quarter because, to the extent that people think that sometimes Donald Trump says things and talks a big game but doesn't do it, he's levying these tariffs. He has threatened to take away vehicle tax credits, and buyers might be saying, hey, if he's going to put a tariff on vehicles and that's going to drive up the cost of an EV, maybe he is going to make good on his promise to get rid of Joe Biden's IRA tax credits, which would be as much as $7,500. So, do you want to pay an extra $3,000 to $5,000 in tariffs and lose a $7,500 tax credit? So an EV buyer might be extra motivated even compared to somebody buying an internal combustion vehicle.
All right, David Welch, great to get some time with you. That is Bloomberg's David Welch. Just to reiterate there, we are getting delivery numbers for Ford. The first quarter retail sales rose 5%, but first quarter total sales down about 1%. We're also waiting for GM today and Tesla coming up tomorrow. But before we get there, we have less than 10 minutes to go until the opening bells. We're joined by Allspring Global's Anne Miletti. She sees more volatility ahead. This is Open Interest. Well, Ed Yardeni has cut his S&P 500 target for the second time in just 3 weeks. Yardeni lowered his target to 6,000 from 6,400. He spoke earlier to Bloomberg Surveillance about the absence of any clear policy for now.
I hope you're not looking for clarity for me, because I'm struggling with all the confusing information coming out of Washington. As you said, you're getting different messages from different people in the administration, and at the end of the day, it'll all depend on what the president concludes he wants to do that day, and he could change his mind again.
Joining us at the desk now is Allspring Global Investments Head of Equity, Anne Miletti. Anne, it's great to see you in person.
Thanks for having me.
So Yardeni is just one of a whole parade of sell-side analysts that we've seen cut their targets. We finally broke below 5,500 again yesterday, retesting that low of the year. We closed back above it. Do you think that we've really seen the bottom, though?
I think we have a little bit more to go. I don't think uncertainty ends, even with tomorrow. I mean, everybody's waiting, trying to get clarity. I don't think we're going to get perfect clarity tomorrow. I think we're going to get the start of what we think this looks like, but likely a lot of change even after tomorrow.
What do you think? What do you think still needs to be reduced in terms of, valuations?
I think, the old saying of companies adjust is absolutely true, but you have to know the rules to the game. And, the rules are unclear. And if you don't know what the tariffs are going to be, if you don't know what your costs are really going to be as a company, it's really hard to manage your book of business. And so, although, I talk to our portfolio managers all the time, they're not getting a lot of CEOs and CFOs are not frightened necessarily, but I think they're just waiting. They're waiting to see what they can do, and that affects CapEx spending. It certainly affects hiring. We're not at the point where we're worried about layoffs yet, but if we don't see clarity by the end of the year, I think we will. That will come into play as well.
CEOs, investors, consumers, the list goes on, just waiting for clarity here. And we are just getting started. Hold tight for just a couple of minutes. Anne Miletti is staying with us at the opening bell. Futures on a downdraft as we count down. That is coming up next. We'll walk you through all the action. This is Open Interest.
We are moments away from the start of trading, the day before the big day. This is Bloomberg Open Interest. I'm Matt Miller, and we're looking at futures that are down, although not big drops after we closed up yesterday on the S&P 500. As Katie said, a little bit of window dressing there. We see futures down about 0.25%, and we were at one point yesterday at 54.88, so below the 5,500 level before that recovery. NASDAQ futures down a little bit stronger, about 0.4%. Russell 2000 futures down 0.3. At the New York Stock Exchange, Go Daddy is ringing the bell, and I took a look at, as I always do, at the comp chart over a 5-year period. If you bought that stock and reinvested dividends, you are a happy camper because it's up 240%. Down at the NASDAQ market site, we have Sanofi ringing the bell together with We Are Ill. Not in the New York kind of Beastie Boys sense, but in the medical sense. They're trying to change the way we perceive of sickness caused by MS. Now, in terms of the stocks on the move, let's get over to Katie Greifeld. Katie, what are you watching?
Well, there's a lot of health names in the red right now, of course, a lot of headlines around the pharma space in particular, but I'm keeping an eye specifically on Johnson & Johnson. That's after a judge rejected Johnson & Johnson's third attempt to use bankruptcy as part of its talc cancer settlement. Separately, we also had President Donald Trump planning to impose tariffs on pharmaceuticals. You add it all together, Johnson & Johnson down about 3% right now.
I'm looking here at an up arrow story in this tough market here. Macy's, they've hired Thomas Edwards, who is an executive from Capri Holdings. He's going to be Macy's new chief financial officer and chief operating officer. He's going to join Macy's on June 22nd and replace his current CFO and COO, Adrian Mitchell, who will leave the company on June 21st. Macy's up now about 2.5, nearly at the market open, Matt.
All right, Tesla, we've seen rebounding in the pre-market. It's doing the same thing in the cash trade. Quarterly sales data for Tesla is out tomorrow. We just got Ford saying they sold the most pickup trucks in March that they ever have in a month as consumers pull that forward. Rival BYD in China, by the way, sold a lot more cars than Tesla is expected to. BYD selling almost 500,000 electric or hybrids, and Tesla is slated to sell 377,000, at least according to analysts. We are back with Allspring Global Investments head of equity, Ann Miletti. And Ann, we're looking at some fallout in the markets from the expectation of tariffs. How do you think traders should play this? I mean, we don't know what Trump is going to say until it comes out of his mouth.
Yeah, look, traders will play it on the short term, but we're really focused on the long term as investors. And we do think that this will cause disruption that will lead to opportunity. And so one of the best pieces of advice I got from one of my mentors was to listen for the quiet. And when I talk to the portfolio managers that I work with every day, what they're talking about now is where the opportunities lie rather than where the risks lie. And I think that's kind of the reversal of where we were last quarter, where we were like, okay, let's think about the risks while everyone else was thinking about opportunity. And I think there really are underlying opportunities. The market is breaking away and changing from one of concentration, momentum, some speculation, to one that's very focused on the fundamentals, very focused on the companies that can, continue to do well and control their own destiny through what's going to be a bumpy ride.
Speaking of bumpy rides, I want to pull up the sectors of the S&P 500 because it's not all red for the year. There is some green on the screen, though even some of the favorite trades have turned around. Yeah. Are you finding any opportunities in the places right now that investors are still looking to hang on to? Energy is leading the pack. A lot of defensive sectors, healthcare, consumer staples. Do you get in?
So I do think defensives, as we knew them in the past, are now becoming defensive again. And the reason why I state it that way is a year ago, people would have said the defensives were the Meg 7. And really what they truly are and historically have been are utilities, staples, REITs, an area that has more steady cash flow and dividends, and they're acting like that again today. And so I think those areas of the market are attractive. I do think certain areas within healthcare, primarily diagnostics and med devices, are areas that will, present opportunity. And natural gas, especially within energy, is kind of a key focus area for a lot of our PMs.
Well, let's focus in on healthcare. It's interesting to hear you name that. Of course, healthcare is your second best performing sector of the year. But one of the most read stories on the terminal right now is President Donald Trump planning to impose tariffs on pharmaceuticals that could lead to higher prices. Pharma is just one slice of the healthcare industry, but I would imagine that has ripple effects. How are you factoring that in?
It does have ripple effects. And look, you have to be careful when you play the healthcare space. But more broadly speaking, if you look at the underperformance of the healthcare space over the last several years, it's been due to the underutilization post-COVID. It's also been, kind of perceptions about what these weight loss drugs, maybe it's partly perception, partly reality about what some of the GLP-1 drugs will do in creating potentially a healthier population going forward. And so utilization trends, all of that pulled back. Valuations pulled back a lot as well. Underlying that, there's still really good innovation within healthcare. And I think that's why the diagnostic space and the tool space, you'll continue to see good innovation that investors will pay for and that, will be willing to pay for going forward. And so I would be selective. Pharmaceuticals did run up with, the surge in what we saw in utilization of pharmaceuticals over the last few years. So it's not a favorite area. It's
such a broad space, right? There's a difference between CAT scan machines, which we're always going to need, and like biotechs, which is like putting everything on red 21. I want to ask about the consumer. I noticed that the subprime borrowers, we have now higher delinquencies than we have since the beginning of 2020. And we're looking at bank balances that are lower, debt that is higher, real across all income levels, real problems for the consumer. How do you see the consumer affected by these tariffs?
I mean, they are affected. They've been affected by inflation over the last several years, and particularly the mid to lower end consumer has been really challenged. And now the impact of potential inflation on top of that will make it more difficult. I think the most critical thing that we're watching is jobs, because consumer confidence has kind of plummeted. They are still spending, but if jobs do roll over in the private space in particular, that's going to be problematic. I do worry a little bit about the retail space, and margins are thin there. If tariffs do have an impact and if demand is hurt at all, it's going to be an area that could be a little bit more challenged than some other areas.
I'm glad you made that point earlier about the energy trade also. I think this ties kind of nicely together, because you're worried about the consumer, but yet energy is being bid up. But if you're worried about the economy, then does that make sense? And I'm wondering whether even some of those defensive areas of the market have perhaps gotten a little too hot.
Yeah, there certainly are. And I think this is where, again, active management kind of comes into play, because it's easy to broad stroke any industry and say this is bad and this is good. But oil acts very differently than natural gas, for example, right? And the tariff impacts and maybe extra penalty impacts that we're hearing about in oil will not necessarily affect natural gas. And so really picking through the energy space is important. Same with healthcare, industrials, et cetera. Watching where government contracts are as government spending gets reduced is also going to be important, and one of the things we're looking at. So we're kind of back to bottom-up fundamentals and really making sure we're paying attention to those rather than just the broad macro issues.
All right, that's a good place to leave it. Always great to see you in person. Such a treat. That is Anne Miletti of Allspring Global Investments. Let's get a quick check on these markets, because the S&P 500 down at session lows, now down 0.5%. Those window dressing flows from yesterday seem to have wrung themselves out of the market, though I will note volume pretty muted right now. Let's take a look under the hood and see what's moving now with Bloomberg's Nora Melinda.
Well, Katie, lots moving under the hood this morning. I'm keeping an eye on airlines companies. We saw Jefferies that downgraded a swath of these companies this morning, and we are seeing them tumbling. This is more on the outlook about the consumer and what the outlook seems to be for corporate spending. The analyst is saying that Delta is likely to cut its annual forecast, but they do expect that American Airlines and Southwest Airlines must cut their annual forecast. We do have Delta earnings that are going to be reporting next Wednesday. They'll be the first to kick off the company's earnings, so that'll be lots to keep an eye on, but also keeping an eye on Intel. So shares were earlier in the green in pre-market trading, but they are since now declining. But analysts were encouraged by the new CEO's messaging during a keynote speech at Intel's Vision 2025 event. They said that he had a candid tone, and he really focused on the idea of rebuilding consumer trust as well as rebuilding engineering. But analysts are still saying that any successful turnaround for the company will take at least several quarters, and it will be difficult to execute. Last but not least, I wanted to keep an eye on a name that's in the green. I'm keeping an eye on PVH. It's the owner of Calvin Klein and Tommy Hilfiger. We're seeing shares up for double-digit gains. They're expecting sales growth to be flat or slightly positive this year. This is different from what the street was expecting. They were expecting about a 0.5 percentage point decline. Evercore is saying that some of the company's initiatives are starting to stabilize the business, but we do have the stock that is still down almost 40% this year.
Nora, thanks very much. Nora Melinda there talking us through a couple of the stock movers. Coming up, the Trump administration targets ticket scalpers and fees on tickets, sending shares of companies like Vivid Seats lower. Details on that executive order next as stocks fall 10 minutes into the session with the S&P down now more than 0.5%. This is Bloomberg Open Interest.
All right, welcome back to Open Interest. A quick check on stocks. We're a couple minutes into the session. You can see that the S&P 500 not quite at session lows, but still having a pretty rough Tuesday, down about 0.3%. Big tech is actually your outperformer right now. We haven't seen that for a while. It's the small caps that are really leading this sell-off. The Russell 2000 down about 0.7%. There's a bullish case out there that these companies are more domestically focused and that they should be more insulated from those tariffs, but you're not seeing that logic play out today. It's time now for our top calls, some of the analyst action in focus this morning. And first up, we have Shake Shack getting upgraded to a buy over at Loop Capital on its earnings upside. The analyst also says that Shake Shack has minimal risk to those tariffs since it sources nearly all of its ingredients domestically. That's good for a 2% rally. Next up, Ulta getting raised to a buy over at Goldman Sachs. Analysts say that the beauty industry has likely reached a bottom and that Ulta is seeing an uptick in sales. And finally, we have Keurig Dr. Pepper getting raised to a buy over at Morgan Stanley on its growth potential. The analyst also says that, quote, the worst is over when it comes to coffee prices, Matt.
Thank goodness. I'm glad the worst is over there. President Trump signed an executive order alongside Kid Rock. Kid Rock was in the Oval Office, and he was dressed like that. That's not a joke. This is real life. We're reporting the news on what's happening in Washington, D.C. In any case, this order is designed to crack down on ticket scalping and fees that drive up the costs of attending live events. It orders agencies to promote competition and ticket price transparency. Shares of Live Nation are actually up right now, and shares of Vivid Seats are down. Bloomberg's Akela Gardner reported on this and joins us. And Akela, you know, it seems like people in Washington, starting with John McCain, have been making noise about this for as long as I can remember, and yet nothing ever happens. These ticket vendors are still ripping us off every chance they get. Do we have hope now?
Well, President Trump certainly hopes that they do. He signed this executive order yesterday, as you mentioned, in the Oval Office alongside Kid Rock, someone who has been a fervent supporter of the president and campaigned with him. And he really talked about musicians don't really see the profits that a lot of these ticket resales have, these added fees that many of these companies add on. But this was also something that President Joe Biden did in his time in office. He called this junk fees, quote unquote. And we saw some companies like Ticketmaster, like SeatGeek, take steps to really show all-in pricing. President Trump is also pushing for those companies to do that as well. He's specifically asking the Federal Trade Commission and the Justice Department to really enforce competition laws. They also ask state consumer protection authorities to take a step up here as well. But this really comes at a time where he's really struggling with his perception on inflation, on the economy. He has good points when it comes to immigration, but that was a huge issue that he campaigned on, and we're seeing consumer confidence really down, of course, volatility in the market, and this is really an area that people feel and Republicans feel that he hasn't paid enough attention to.
Yeah, you know what's pretty fascinating to me? Not only are Live Nation shares now higher on the day, they are higher on the year in a market that's been broadly down. They have been soaring really the last couple of years. You don't see the same for Vivid Seats. It's gone the other direction. Given that both administrations have had such a strict stance on what's been happening here in terms of ticket pricing, is this the kind of final move, or is there still a pathway in which there isn't more of a crackdown on these fees and on these prices?
Well, the president does ask agencies to come up with a report in 180 days, but we're really going to have to see if these companies make any changes. Like I said, some of those companies have already made major moves to show more transparent prices. Perhaps Vivid Seats will get in there as well. But President Trump is certainly saying that this is something that he's going to look at broadly. And at the end of the day, he's also looking at things like no tax on tips. So he's certainly trying to show that he's looking out for the little guy, for consumers. And there's really a lot of pressure on him to do that, particularly as he's talking about these tariffs. And there's a lot of concerns that those are going to eventually raise consumer prices as well.
Akela, we thank you so much for all of your reporting. That is Akela Gardner of Bloomberg News. Now, we want to bring you some breaking news as well, because, of course, we are getting data throughout the hour, including manufacturing PMI, where the reading was actually a little bit higher. You're looking at a 50.2 reading versus, I believe, 49.8 that we had been looking for. We are looking at the S&P 500 now. It's been reacting throughout the morning. It is barely down now, pretty much flat on the morning. Remember, we have more data still coming up, including JOLTS at the top of the hour, including more ISM data.
Yeah, the NASDAQ 100 turning positive, big tech leading the way here. Looks like the S&P 500 isn't too far behind, but it's hard to really get a read on these markets and look at any move with any conviction right now when we know the big day is coming tomorrow, Matt Miller.
Yeah, and it won't even be until the afternoon, right, that we actually get these announcements.
Didn't we have a countdown clock? It was like 1 day and 5 hours.
Let's bring the countdown clock back.
I mean, the hard
there
thing
it is.
it's not even just tomorrow. If we're looking at all the economic data, you have traders reacting, but it's Friday also with the jobs data. That could be another big point to look at in the week.
Yes, every other day there will be some important thing for the market to move on, even every day in this administration. But maybe we can just look forward to 11 minutes from now and we'll get the JOLTS data. We're going to bring you that with Mike McKee, I believe. So you'll see job openings. Neil Dutta sent out a message this morning. Job openings continue to decline, and that's just one more concern for consumers.
Certainly something to keep an eye on, as are shares of Newsmax.
Yes, we're going to be looking at that next. It's crazy. We've seen some IPOs in this market. Retail investors are riding the wave, particularly for Newsmax. As Katie was saying, the stock has been soaring after its initial public offering. We'll take a look at that next. This is Open Interest.
This is Bloomberg Open Interest. Get a check on what's going on with stocks right now. Kind of evening out in terms of the S&P 500. We were off more than 0.5% a few minutes ago. Now we're only down 0.2%. The NASDAQ 100 down even less. Take a look at some of the movers here. NVIDIA, obviously a huge drag. If it moves more, it could sway the indexes. Tesla actually up 2%, which I think is interesting. They don't have their sales figures out till tomorrow. Ford sold the most pickup trucks in a month ever in March as demand was pulled forward. General Motors, you can see, down about 0.5% here. This is, to me, one of the most interesting and would be infuriating to me if I were an owner of Newsmax shares that hired an investment bank to sell them for me in an IPO. If I give you something for $10 and the next day someone is paying $125 for it, I want to know where's my cut, Sonali. That would make me very, very angry.
Oh, we are going to get so into it, Matt, because it's a tale of two IPOs. Newsmax is surging in the IPO debut, while CoreWeave has struggled since its downsized IPO. We're going to break down both stories with Bloomberg's Bailey Lipschultz. Okay, Newsmax, let's just start there to Matt's point here. It priced at $10. It's trading at nearly $130, 13 times higher. Didn't hire a major Wall Street bank, hired Digital Offerings LLC. Really interesting move there. What is going on?
Guys, we see this from time to time with tiny IPOs. $75 million is pennies relative to bigger banks. When we look at some of the data, and we had a chart in our story yesterday, we had a number of companies, about 24, when you go back in the last 5 years, that popped more than 300% in their day one IPO. So we're talking about companies, Matt, maybe you've never heard of: UPower, Molecule Group, Newton Golf Company. My favorite is Adentax, was up 13,000% day one.
I think it's a Dentax.
A Dentax, okay.
No, I have no idea. I have no idea. I've heard of none of those.
It sounds official, but all of those pretty much down 100% from the peak. This does happen. There is maybe a retail meme flavor. We are seeing the likes of kind of chatter on StockTwits. We've seen it popping up on Fidelity's platform among their top 25 most bought companies. You do have scarcity value, so it's not a big float. Not a lot of shares out there. If you bought it at 10, you don't want to sell it yet. And if you're on your Robinhood app trying to get orders in, you're just market buying.
And, you know, to Matt's point here, because they didn't hire Goldman, maybe since it's a small IPO, they saved a little money there in terms of the public offering.
If you don't hire the bank that's paying $80 million to its CEO
well,
and
I'm
COO.
sure that some of the bankers at Goldman are watching this and chuckling a little bit. But I want to talk a little bit, too, about just the types of IPOs that we're seeing in terms of size specifically, because you have Newsmax, you have CoreWeave, which, by the way, is up today, even though it had a pretty rough debut last week. These are smaller companies. They're not tiny, but they're not huge either.
Well, it's very much a divide, right? So when you look at year to date, we have 3 IPOs to raise more than $600 million. CoreWeave, one of them at $1.5 billion. So that is what we would call a blockbuster IPO, one of the biggest IPOs, biggest tech IPO since ARM in late 2023. But to your point, with a lot of these small deals, that's when you see stocks swing wildly. So they're very much different in that way. Obviously, their banks are different. The buyers who are trading this are different. I think that if you talk to a fundamental investor about CoreWeave, the thought is the long-term thesis. If you're talking to someone who's buying Newsmax at $130. I'm going to assume they're hoping that someone wants to pay $200 for it.
Greater fool.
But that's kind of where it's at. And it has shades of meme stocks, but also of kind of D-SPACs that we've tracked.
Bailey, great to have you on because you covered all that stuff for us. When we come back, we're going to talk about the economic data in the next hour. And Jim Tananbaum joins us of Foresite Capital. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
I'm Sonali Basak.
And I'm Katie Greifeld. We're taking a look at these markets right now. Still a downdraft in the S&P 500, but we are waiting some eco data. Here's the state of play as we count down to those JOLTS figures. You can see the S&P 500, the NASDAQ 100, both lower. A little bit of bid coming into the bond market right now. And here we go. We have the JOLTS readings for February coming in a touch lighter than the survey, about 7.568 million jobs there. The survey had been for 7.65 million. Let's get right now to Bloomberg's Mike McKee to make sense of these figures ahead of course, the big day on Friday.
Well, really, Katie, the big figure that's going to affect Wall Street right now is this ISM manufacturing number that comes in worse than anticipated and down into contraction territory again. 49 even. Last month was 50.3, and the expectation was for 49.5. New orders fall to 45.2 from 48.6. Employment falls to 44.7 from 47.6, and prices paid jumps to 69.4 from 62.4, a big jump in terms of what might be coming down the road in inflation, or it may be related to people trying to buy stuff ahead of the president's tax situation. But in terms of the JOLTS numbers, we do get a decline in the number of jobs out there, which was expected, but it's more than anticipated, 7,568,000. The quits rate is 2%, which is down a tick from 2.1%. Now, these are February numbers, so they're a little out of date. And at this point, the Indeed job posting numbers have shown a bigger fall than the JOLTS numbers. So it does suggest that there are still jobs out there, but it doesn't look like from all the other data that we've gotten that people are hiring. And certainly this ISM figure suggests that manufacturers are not hiring.
So everything that we've gotten, Mike, and there's a whole wall of data here on the Bloomberg terminal, is going the wrong direction, right? I mean, manufacturing, it's contracting more than we thought it was going to. Prices paid, they're higher than we thought they were going to be. Job openings, the amount of jobs available to me if I leave here, they're lower than we thought they were going to be. And then people leaving because they're comfortable to go, that's fewer than it was previously. So every single piece of data coming out is bad.
That is correct. Now, the JOLTS data is hard data from 2 months ago, though. The ISM data is what we call the soft data, and that just reflects what we have seen in terms of consumer and CEO confidence. People are worried about the impact of tariffs and what the president's tax increase is going to do to the economy. And it looks like manufacturers pulled back during the month. Now, we have to see if this is a sign that the economy is going to go bad and manufacturing is going to really contract, or is this just everybody slamming on the brakes until they know what happens?
All right, Mike McKee, stay close this week. It's a big week for data. That is Bloomberg's Mike McKee. You take a look at the reaction in the markets right now. The S&P 500 returning to its session low, now down about 0.5%. Big tech also lower on the day, down about 0.4%. Bond markets catching a little bit more of a bid, sending the 10-year Treasury yield down about 5 basis points. Going back, though, you take a look at what is the worst performer right now on a sector level in the S&P 500. And Sonali, it's healthcare, down 1.3%.
Yeah, and it's a really interesting place to take it now because, of course, there's that threat of pharma tariffs. There's, of course, those exits at the FDA. We're going to turn to the healthcare economy because vaccine makers like Moderna, they're struggling to recover this morning after that top FDA vaccine official had stepped down, and he cited friction with the new HHS Secretary RFK Jr. Analysts at Cantor Fitzgerald are calling on the Trump administration to reevaluate Kennedy's role, saying that he is, quote, steering this country country into dangerous territory based on his own whims and invalidated beliefs. Trump's tariffs are also expected to have a strong impact on biotech companies in particular. Joining us now, Jim Tananbaum, MD, founder and CEO of Foresite Capital, a U.S.-focused healthcare investment firm. Great to talk to you about all of this from an investment perspective. And it's hard to know where to start between the tariffs and what's happening at the FDA, but let's maybe start with the FDA. Given how much the market has reacted, how are you thinking about those moves from your seat?
Well, I think Mark McCary has his job cut out for him. He needs to rebuild culture. He needs to rebuild the agency. He needs to align with the current administration. And he needs to deliver the very best drugs for the country in even more efficient time than the previous FDA has been able to do that. And that's a tall order, but he is by all reports up for that. And what's also really interesting is innovation in the biotech sector has been very strong over the last few years. There are a lot of factors that are heading to a whole slew of new products, new ways for us to think about healthcare, and AI on top of all that will make it individualized. So we're heading into an era where there's going to be unprecedented opportunities for the FDA.
Well, let's talk about that a little bit more, because you mentioned McCary. He has his work cut out for him. You take a look at some of the sell-side notes that came out yesterday after we learned of Peter Marks' departure, and they seemed positive on McCary, but they were worried about the overall direction of the FDA. And I just wonder, as an investor, how do you approach some of those questions that are being asked right now?
Well, I mean, I sit as a venture capitalist. So first, venture capital is about transformation, and transformation are about 5-year, 10-year, sort of long macro cycles, and they're about dramatic improvement over, sort of baseline. And it's my belief that the current changes that are going on right now are not going to take away from the fact that America wants the very best therapies. America wants innovation and transformation. And so, so I think that's the big picture. And in my world, you just welcome my world. You just don't get rocked by a lot of noise that comes across in the short term.
Well, I just wonder if this could have a positive effect or a negative effect on your business. I mean, if the Trump administration is going to cut 10,000 jobs at the Department of Health and Human Services, does that make it easier for you to get your work done because there are fewer regulators, or does that make it harder for you to get your work done because there are fewer people, there are fewer regulators?
Well, time will tell, but it could go in a bunch of different directions, and changes, brings uncertainty, and that's, and that's a little scary in some ways. But the flip side of it is that there's great opportunity to, to bring incredible products to market, and there are a lot of smart people out there that want to work for the agency.
I just don't know how to draw a parallel, because if I think in terms of the IRS,
yeah.
Right? Initially, you're sort of knee-jerk as a taxpayer. You're like, yes, fewer IRS workers to take my money away. But then you realize that your refund isn't going to take 6 weeks. It's going to take 16 weeks to get your bank account,
or the
right?
financial services sector, where fewer regulators, a lot of people are excited about it. But in your case, you need these drugs to get approved.
Yeah. Well, there's going to be short-term uncertainty, for sure. But I think the big picture is innovation is going to win. I think that's the big picture. It's going to win because it's right for America. It's going to win because it always does.
So you have a broad portfolio here. You have healthcare tech, you have life sciences, you have therapeutics. As an investor, do you pivot? Do you shift to some areas versus others based on what's happening in the macro right now?
Yeah, a great question. So first, I think we're living in an unprecedented time. Over the last 30 years, I think that this is probably the most fertile time for transformation over the next decade. What's going to bring that? Well, AI is already we're starting to see the transformative effects of AI across many different segments of the economy. It has not started yet in healthcare, really. Genomics, gene editing, all the advances in biology, all put together with AI systems, are going to enable things like computers designing drugs, like actually doing the whole drug design start to finish. It's going to enable the change of the whole healthcare economy from an economy where healthcare is delivered to the average person with the average care for that person to individualized healthcare delivered. And that individualized healthcare is delivered by AI bots that are specialized for you. And what do they help you do? They help you figure out how to live your longest possible life, given your genetics and given whatever else can be measured that's modifiable. So so now the technology is available for this.
Right.
It's going to be put together, and it's going to get rolled out over the next decade. and it's going to be stunning in terms of the impact that it has on all of us.
Well, Jim, I'm really eager to hear your thoughts specifically on GLP-1s because I'm taking a look at the notes you sent over. You talk about category killer therapeutics. I think it's safe to put GLP-1s in that basket. And it kind of reminds me of AI because you have just a few leaders and then you have a bunch of other companies trying to catch up. I think something similar is happening in the GLP-1 space. What does that mean for you as an investor?
Well, first, I think in general, winners take all. You know, and the GLP-1s that have won here are really good. They're both very good. The Novo product, the Lilly product, fantastic. By the way, it's a product that helps you look better, but also helps you live longer. Right. And that's a key thing. It's been studied for, basically cardiovascular, effects. It's been shown to be superior for those people that take it. And why? Because it takes fat, it makes your blood cells more efficient to insulin. It takes fat away from liver cells and kidney cells and probably nerve cells, but all the cells in your body. Anyway, there are other category killer categories that are coming along right now. I think a really interesting one is pain. I mean, God knows we need less opioids. So there's a new class of pain medication that was just introduced by Vertex. It's called the NaV1.8 inhibitor. It works right at the nerve. And we're going to see that whole family, NaV1.8, NaV1.7, NaV1.9. We have a company in the category, Latigo. But these are pain-relieving medications that are non-addictive, non-sedating, get rid of opioids. That's a big category. That's something we're all going to use. Another area for those of us that have autoimmunity is there's a whole series of next-generation products for autoimmunity. One wave takes all these biologics that are used, all these injectables that are used for autoimmunity, turns them into pills. Johnson & Johnson has one that's coming to market. It's an oral IL-23. We have one that's coming to market in the next generation TYK2 inhibitor. These are game changers for people.
By the way, speaking of game changer, are you going to start watching where the companies you invest in get the ingredients that they put in these solutions? Because I saw a stat in a Bloomberg story this morning that 90% of biotechs have products with half of the ingredients imported from overseas, i.e. they're going to get hit by tariffs.
Yeah, yes. Well, we're going to look at, we always look at chain of everything, right? And so you want duplicity of chain. And now when you look at chain, you're looking at U.S. And that's the whole idea, right? The whole idea is to include U.S. as part of the chain. And right now, if you were to look at that chain, as you said, it's not U.S. There's not one line of the chain that's U.S. So that, for sure, is a side effect of that. And that causes some short-term inefficiencies, but, is long-term better for all the people in chain that are in America.
We're talking so much about investment opportunities, but I'm equally interested in exit opportunities. You are looking at an M&A market that has been pretty shut, but you're investing at earlier stages. I'm wondering what the prospects are to exit these companies. Do you feel that you might have to wait, given what the market looks like?
I think a combination of corporate tax cuts, the FTC, a way better FTC environment, and the need for pharma to fill their pipelines are going to mean that the M&A is going to come back in our segment.
January feels like a long time away. Katie was talking to every pharma executive ready to buy. It'll come back.
We've been waiting for this to happen. We just haven't seen it, right? We haven't seen the
it doesn't happen. My world does not move by the minutes. It moves by quarters and years. And I think that directionally, over the course of the next couple of years, you're going to see a lot of purchases in pharma.
Jim, we thank you for joining us here on set. That is Jim Tananbaum of Foresite Capital on an industry a lot of investors are watching very closely at this juncture. Now, coming up, the $80 million retention bonuses for Goldman's top two leaders are gaining another prominent critic. We're going to talk about what's going on there next in the Wall Street Beat. This is Bloomberg Open Interest.
Let's get now to high interest. Look at what's making headlines around the world. A year-long rally in global credit may be ignoring recession risk. Chris Ellis, a portfolio manager at AXA Investment, is sounding the alarm on this so-called gray swan event. In contrast to the sell-off in other asset classes, very little bad news has been priced into credit markets so far. Strategists at JP Morgan model that in the middle of last month, the S&P 500 was pricing in a 33% chance of a recession here in the U.S. Credit, meanwhile, was only pricing in 9 to 12% odds. And it's a Bloomberg scoop. Howard Lutnick is signaling he may withhold promised CHIPS Act grants as he pushes companies to expand their U.S. projects. The Commerce chief wants firms that won awards from the 2022 CHIPS and Science Act to follow in the footsteps of TSMC, which recently announced it will invest another $100 billion in U.S. plants on top of a previous $65 billion pledge. Big Goldman Sachs bonuses are drawing criticism. The firm's $80 million retention bonuses for both the CEO David Solomon and President John Waldron are, quote, poor practice, according to Institutional Shareholder Services, which is urging investors to reject the big payouts. The proxy advisor added that the pricey incentives lack rigorous preset performance criteria, which is particularly concerning for off-cycle awards with such large values. In a second recommendation late last week, Glass Lewis described the latest bonuses as excessive. Sonali?
We are going to get into those Goldman pay packages in today's Wall Street Beat. Joining us now, Bloomberg finance reporter Todd Gillespie. We've seen this before, not always at Goldman. We've seen it at JP Morgan, for example. We've seen instances when you've had these proxy advisory firms push back. It doesn't always mean the bank makes changes. The shareholders then have to vote on it. How do you expect this to play out based on what we've seen happen in the past?
Yeah, I mean, totally makes sense, right? Back in 2021, when Jamie Dimon, or 2022, I think Jamie Dimon got handed a $50 million retention bonus just out of the blue. You know, shareholders voted against that. I think only 31% of shareholders at the time voted in support of that pay package. But and what? These banks can still go ahead most of the time regardless, can still hand out these bonuses to these executives, right? These banks are citing, you know, super fierce competition for top executives at the top of finance, particularly in an environment now where banks are, you know, fighting for talent against private equity firms with deeper pockets. You know, we know that John Waldron, for example, has had to turn down jobs from other top PE firms across the street. Goldman claims that it's doing what it needs to do to attract top talent. Whether this is the right way to do it, who knows?
Yeah, we'll have to see there. And as you mentioned, these are retention bonuses, specifically when it comes to John Waldron. But, I mean, have we ever seen a case where then the bonuses were knocked down? I mean, where realistically will this go, other than having a bit of bad press?
It's pretty unlikely they're going to be knocked down at this point. I think it would also show that Goldman, it would be a bad look for Goldman probably from an optics perspective if they were to knock them down. I mean, one thing Goldman does say is, right, that these are stock-based awards. It's technically not $80 million each. It's $80 million worth of shares back in January. So the value of this could go up or go down over the next 5 years for these executives. So they argue that, these are aligned with what shareholders want. You're incentivizing David Solomon and John Waldron to do the best work that they can to increase shareholder value because it's now in their own interest more than it ever has been, right? But one thing that ISS is just saying, and they came out last night with this report, is that it's quite poor practice for banks to be having multiple off-cycle bonuses at the same time, because both John and David got similar retention bonuses back in 2021, which still actually haven't vested yet. They vested in 2026, $30 million for David Solomon back in the time, and $20 million for John Waldron, roughly speaking, based on the on the price of those shares back when those were set. So they're really laying it on thick right now.
Is there anyone out there who says, I don't care if you pay David Solomon and John Waldron $80 million each. Give them $100 million each, because their stock has returned 315% over the last 5 years. They've beat out every single bank on the street. They've done better than JP Morgan. They've done better than Bank America. They've done better than Wells Fargo. They've done way better than Citi. I mean, as long as I'm making money, what do I care if they're making money?
Yeah. I mean, to be fair, over the past 5 years, if we're taking the depths of COVID as the benchmark, it's a little bit difficult. But yeah, you're right. Like it's
I
over
always look at a 5-year period just to make it fair. I'm not cherry picking duration, right?
Sure.
I've been looking at a 5-year period for 25 years.
Sure.
Right?
Yeah. I mean, it makes sense. I mean, yeah, and it's 140%, I think, since David Solomon became CEO. So yeah, I mean, one could say absolutely, sure, these make sense, but at the same time, it's like, how do you know that these are the executives that are actually, the ones absolutely, without them, could Goldman have got the same share performance that they have done? It's hard to know. We don't know that counterfactual.
But to me, as an investor, if you quadruple my money, I don't care.
Sure.
Right?
Sure. Yeah.
It's interesting, too. I've got to say, just a quick comment on this also. What's interesting to me is that both David Solomon and John Waldron this year was tapped to actually join the board also. And so a lot of the decision-making really coming up to these two folks, and John very obviously being kept around to try to keep the top job. Todd, we have to leave it there because we're out of time. Could go on. Todd Gillespie, of course. And not that you guys want this note, but we are only about a couple weeks away now, less than a couple weeks away from bank earnings. So we'll see if the money they bought in the last year is matching, and the first quarter is matching the last couple of years. Now, still ahead, we're going to look at some more stocks under the surface. Roblox launching a new format of video advertising on its gaming platform. We're going to give you details on open interest next. This is Bloomberg.
Welcome back to Open Interest. Let's get back to these markets right now because the S&P 500 hit session lows. It's now down about 0.6%. I want to go right under the hood and take a look at what is leading the declines, at least on a percentage basis. It's the airlines right now. Delta down 5%. United Airlines down another 5% as well. You take a look for reasons why it might come from the sell side. You had a Jefferies analyst coming out and downgrading American Airlines and Delta from a hold or to a hold from a buy rather. Southwest, Air Canada also getting some downgrades as well. That's really weighing on the sector right now, as well as you consider the potential impact of tariffs. Some venturing that maybe you'll see less Europeans traveling to the U.S., which obviously would hit some of these companies. Speaking of other companies, they're across all industries preparing for President Trump's tariff announcement tomorrow. We'll get a read on the shipping industry next. This is Bloomberg.
A proposed U.S. trade measure has sparked widespread concern in the shipping industry. It would impose million-dollar levies on Chinese ships docking in the U.S. And critics argue it will divert trade away from U.S. hubs, but supporters say it will curb China's dominance in shipbuilding and logistics, and maybe more importantly, bring jobs back to America. This is all ahead of President Trump's tariff announcement tomorrow. Joining us now to discuss the effect on the shipping industry is John Wobensmith. He is the CEO of Genco. John, great to have you here. I guess, first off, talk to us about your own fleet. I mean, how many ships are built in China versus, how many are built here?
Yeah, well, certainly zero are built here. We do have a lot of Chinese-built ships, but less than 10% of our revenues last year were U.S.-based. But we have, shipping has a way of figuring things out once there is clarity. So things are a little fluid right now, but if you look at major supply chain disruptions, over the last 5 years, Panama Canal last year, right, with low water levels, the Red Sea, which is still currently going on, COVID, shipping finds a way to move goods from point A to point B. So what we're doing is we will either position our ships elsewhere. There's plenty of global trade. We're a global player. As I 10% comes from the U.S. That means 90% is coming from the rest of the world. The other way to handle this is passing through to the end user, which we would have no choice to do. We've done a couple fixtures in the last week and a half. This is all very, very new to the industry, but we have inserted clauses into our charters to make sure that the end user is ultimately responsible for any tolls or port fees that arise out of this.
There's a lot to dig into there, especially when it comes to passing on costs. But I want to go back to ships. You mentioned you have a number of Chinese-built ships. You're taking actions to sort of mitigate that risk. What about buying U.S. ships? I mean, what kind of price differences are we talking about between a Chinese-built ship and a U.S.-built ship?
So the U.S. shipbuilding industry has diminished significantly since really the late 1800s and through World War II, right? That was part of our major industrialization that happened in the U.S., and that's why you're seeing Asia being dominant, China, Japan, South Korea in shipbuilding, because they've been industrializing. In terms of U.S. shipping, we are we're very much in favor of building and revitalizing U.S. yards. But we look at it as three pillars. You need the infrastructure, which is the physical yards itself, which can take decades to get into place.
Right.
You need technology, and you need a workforce in order to build this ship. I mean, let's face it, it's not Rosie the Riveter like World War II right now. There just isn't that trained workforce. And then we need crew.
Right.
So we need more out of the merchant marine academies, the maritime academies across the U.S. and the training that goes with that in order to really revitalize that industry, which we think is a fantastic goal.
Right.
We just don't think it should be necessarily married with the Chinese issues.
Right. And I hear what you're saying, that, I mean, it's not like flipping a light switch. This is something that's going to take years, if not decades, when it comes to revitalizing the U.S. shipping industry. But just to distill what you're saying, are there ships that are suitable that you could purchase, or do they not exist?
They do not really exist in dry bulk. And just going back to your original question, if you're building a ship in Asia, and again, that could be Japan or South Korea and China, it's easily 3 to 4 times more expensive now to build in the U.S. because there just aren't that many yards. And again, you've got a very low workforce, and all of that would need to be revitalized, and it does take some time. It's not turnkey.
I just want to bridge the gap here a little bit, because if you are an everyday American who doesn't know a lot about shipping, you think about trade and you think about tariffs. That's the word that comes up most prominently. But you have a shipping expert calling this to Bloomberg News, this Levies on the Chinese-built ships, a trade apocalypse. When you take the tariffs, this issue with the shipping, with the Chinese-built ships as well, plus, as you said, the disruptions that still exist in the Red Sea, altogether, what's the impact?
The impact is freight rates will go up, no matter what. And unfortunately, there's no choice but to pass that along to the cargo owner and ultimately the consumer. Is it an apocalypse? I don't tend to be that dramatic. But if you look at certain commodities, so let's look at U.S. farmers. So they have already been had a retaliatory tariff put on them by the Chinese of 25%. So already making soybean in particular uncompetitive. The Chinese are buying a lot more from Brazil. By the way, the farmers export anywhere from 30 to 40% of their crop on an annual basis. They're also dealing with higher input costs on fertilizer and energy. And then if you add port fees on top of it, they become uncompetitive in the world market. So their exports will come to almost to a grinding halt. Other commodities, so cement comes into the U.S. in large quantities. That will continue to flow. It's just the cost will go up. Gypsum, another one. You may not know what gypsum is, but that goes into drywall. Building materials, they will go up. So, you know, there's probably demand destruction in agricultural products on the export side, but then inflationary aspects to other goods. And then if you look at the containers, this is also interesting. You know, the containers, I think, is a lot less of a problem from an inflation standpoint. I think it will be passed along because it's such a smaller number. These are very large ships, a lot of boxes to spread out the flat port fees on. However, a container ship usually calls 3 to 4 U.S. ports. They will most likely, and this charge is right now anyway, proposed to be on a per port basis. So instead of calling 3 or 4 ports, container ships will most likely call 1 port. That will increase congestion. That pushes up freight rates. The ports, the smaller ports that they're not calling, will lose business.
All right, John, we got to leave it there. Fantastic to speak with you ahead of that tariff announcement coming tomorrow. That is John Wobensmith of Genco. Meanwhile, let's get a check on these markets right now. About an hour into the U.S. trading day, you can see that stocks still under pressure here. The S&P 500 down about 0.5%. The NASDAQ 100, big tech, also not faring too hot right now, down about 0.4%. That rally has been building in bonds while we've been on air, and you can see that 10-year Treasury yields currently off by 7 basis points. If you round a little bit here, Sonali, we are at 4.14% on your benchmark 10-year Treasury.
It is a pretty incredible level. We will keep an eye on it, particularly as we move through tomorrow and through to more economic data through the end of the week. But for now, let's get a look at stocks moving under the hood this hour. For that, we bring in Bloomberg's Nora Melinda.
Sonali, I've got eyes on Newsmax this morning. We're seeing the company surging for triple-digit gains. It's pairing a little bit now, but really on a roll. And this is after the company IPO'd yesterday. We know that this is a conservative media outlet owned by former New York Post journalist Chris Ruddy, and it really gained popularity during the presidential election period, and we're seeing a lot of Wall Street celebrating it. We saw the stock end about 780% higher at the close yesterday, but really on a roll here. I'm also keeping an eye on entertainment stocks like Live Nation and Vivid Seats. They're lower, they're trending lower this morning, and that's after President Donald Trump signed an executive order essentially trying to pull back on different scalping fees and other additional fees. He wants more transparency when it comes to purchasing concert tickets or any other entertainment tickets. We had our colleague Kayla Gardner in D.C. Write that up yesterday. But he's ordering that the FTC work with the DOJ to really crack down on this area. Lastly, I'm looking at a name in the green. That's PVH. It's owner of Calvin Klein as well as Tommy Hilfiger. It's up for double-digit gains this morning. They're saying that they expect sales growth to be flat or slightly positive this year. That's against what the street was expecting. They were expecting a decline of about a 0.5 percentage point for this company in terms of sales growth. Evercore is citing that some of the company's initiatives are starting to stabilize, but we do need to note that the stock is still down almost 40% year to date, Sonali.
Nora, thank you so very much. I want to bring you some breaking news as well, because a highly watched story in the world of hedge funds. Two Sigma's John Overdeck is returning to the management committee. Now, this comes 8 months after he relinquished day-to-day oversight of the firm that he co-founded. Co-founder David Siegel, however, will not be returning. In a separate memo seen by Bloomberg, he says that he has full confidence in Scott Hoffman, one of the co-CEOs. The newly installed co-CEOs, Carter Lyons and Scott Hoffman, will keep oversight of the daily operations of Two Sigma in a turn of events. Now, coming up, we're going to go back to the markets. We're going to bring in Keith Lerner. He is Truist Advisory co-CIO and chief market strategist. He says now's the time for investors to get more neutral. This is Bloomberg Open Interest.
All right, let's get a check on these markets right now. The S&P 500 off its worst levels of the session, still down about 0.2%. There's been plenty of volatility, and Keith Lerner over at Truist Advisors says that there's more to come. He's advising investors to be more neutral and less on the offense, writing that, quote, "We expect the choppy market environment to persist over the next several weeks and likely months, and we are not likely to see a quick return to new highs." I'm pleased to say that Keith joins us now. So, Keith, new highs is one thing, but do you think we've seen the bottom?
Oh, that's a tough question right off the bat. I think we've seen a short-term low likely in the market, but I just think the upside's capped. And just for context, we downgraded stocks after being bullish back in late February around 6,000. And our point was that the risk-reward was more mixed. Around 5,500, at least you're reflecting some of the uncertainty. You know, when you're down 10%, you're effectively pricing in about a 1/3 chance of recession. So at least some of that bad news is priced in. But, you know, at the same token, even though there's so much discussion about tomorrow, this big day we have ahead on the tariff announcement, as we look at the data itself, what we're seeing is obviously we're seeing the consensus bring down their economic forecast. That has not yet translated into profits. So we think there's some downside risks to profits and also profit margins with tariffs. Maybe one last point. That's offset by when you're down 10% historically. When you look a year later, we've had 56 instances going back to 1950. 49 out of those 56 instances, we've been higher a year later. So if I see like I'm saying somewhat neutral, is like on one hand, yes, 10% corrections is good. On the other hand, you're having some changes in the fundamental story, and we think a more neutral posture makes a lot of sense here.
Do you aren't you concerned that we get more and more negative news, economic hard data going the wrong way? I mean, we got jolts that were all wrong today. We got ISM that was all wrong today. And I mean, inflation numbers, CPI and PCE have been pretty good, but it looks like they're set to get worse and worse. The same could be said for growth.
That's right. And I think part of the market move down is a reflection that there's an anticipation that we will see some sluggishness. Now the question becomes how much. And now as we talk to some of our, like say, retail analysts, they're seeing certainly some sluggishness, some slowdown in bookings for the summer. Think about hotels, lodging. I've even heard something, somebody talking about, a slowdown in mattress sales, which is a very discretionary type of purchase. So I think we're going to see that. And that's also why I think the upside is capped. If the market was priced, much lower, was still around the 20 multiple, I might be more interested in saying, hey, all the bad news is priced in. But in our view, you're trading at a 20 multiple and you have downside risk to earnings. So going back to the point about, where the market is, I think as we get back to 58 to 6,000, there's just a lot of selling pressure, which makes for a choppy market. And relative to where you would have been a year ago, we think a more defensive posture, at least neutral posture, makes more sense today.
One thing I find pretty stunning is that to find some safety here, investors are going to the bond market to look for diversification and a little bit of cover. But you're seeing dueling narratives. You have recession worries, you have potential inflation worries on top of those as well. Yet you have the likes of PIMCO saying that you could expect as good, if not better, returns from the bond market in the near term, and investors bidding down the 10-year to at least 4.15% at the moment. Does that all make sense to you, or do you think that there's an overcorrection in the move that you're seeing?
It actually does make sense, because I think as much as there's concerns about a one-time tariff hit, the market is clearly telling us they're more concerned about the growth scare, the growth side. And one of our big themes coming into this year was bonds are back, keep it high quality, and you are seeing that diversification benefit as well. And I will say, just more on a technical level, that 410 level on the 10-year Treasury is an important one. You break below that, it actually opens it up for some more downside. But even regardless of that, we just think that bonds are going to continue to provide, one, income, and two, stability in a market that's likely to remain somewhat choppy. And you're also seeing that defensive characteristics when you look at, gold, utilities, other areas, kind of saying a similar narrative that there's concerns around the growth outlook more than the inflation concerns.
Yeah, it was amazing to see in the first quarter. You actually had bonds rally and stocks fall. The first time we saw that happen in a 3-month period since 2020. So that certainly tells you something. You mentioned, of course, bonds in conjunction with gold. And when it comes to havens and sort of those defensive plays, where are you looking specifically in the stock market? We were having a great conversation with Ann Miletti that the classical defensive sectors are acting as defensive sectors once again. Are you looking towards some of those names?
We are, and again, we're looking at it in a portfolio context. So we have a little bit more cash. When we downgraded stocks, we raised our cash slightly. We've had gold. We've been bullish on gold over the last year. And then specifically to your question around sectors, we like utilities. Utilities are correlated with rates, so that's important to know. But they are relatively cheap. They're trading at about a 12% discount to the S&P. You have more stability in earnings relative to the overall market if we slow down. They're not really front and center on the tariff side. And then I layer on the technical side. We're seeing an improvement in relative price trends. So on the defensive side, I think that's certainly one that stands out. We are still overweight communication services and financials because I think this tug of war is likely to continue. But on the defensive front, I think that combination, what we discussed, utilities, bonds, cash, really is a nice combination today.
Keith, great to have you on the program. Thanks so much for joining us. Keith Lerner there of Truist Advisory on a day when the market is down. We do see Tesla shares rising pretty significantly. We were showing them up in the pre-market almost 2%. And then after the live trade kicked in, they started to climb. And now Tesla is up to $270.84. Even though it has yet to come out with its first quarter sales numbers. We don't expect those exactly until tomorrow.
Yeah, it's your biggest gainer on a points and a percentage basis in the S&P 500 right now. Tesla is, but it's not exactly helping the big benchmark right now when you have nearly 400 names moving to the downside. We'll continue to track what's going on in these markets. And coming up, the arrival of Trump's tariffs looms over global markets. We'll have the latest on the president's plans next. This is Open Interest.
Let's turn back to our top story. The president is set to unveil his global tariff plan tomorrow in the White House, in the Rose Garden specifically. He's offered some clues so far to what we're going to get for the latest Let's Head to Balance of Power host, Kayleigh Lines in Washington. So the president has said, Kayleigh, he's going to be putting reciprocal tariffs on countries that aren't quite as high as they tariff us. Should we take him at his word?
Well, we'll find out for sure tomorrow. I would point out it's today, Matt, that we're expecting the president will receive the reports from some of the most senior trade authorities within his administration. April 1st was that deadline for the Treasury Secretary, Scott Bessent, the Commerce Secretary, Howard Lutnick, and the U.S. Trade Representative, Jamieson Greer, to present their reports to the president about the trade imbalances and deficits, currency manipulation practices if countries are undertaking them, and ultimately what should be done about it. That said, even though he didn't have those reports in hand in theory, President Trump did tell reporters in the Oval Office yesterday that he settled on the idea around these April 2nd tariffs a long time ago. And to your point, Matt, he suggested that in some cases the numbers will be lower than what other countries charge us, the U.S., in terms of import tariffs, suggesting this won't necessarily be the same rate that is applied to U.S. goods that other countries are importing. He's described it as, relatively speaking, he thinks the administration is going to be, quote, very kind. We just don't yet have a sense of what exactly that so-called kindness entails.
Kayleigh, while we have you, it's worth getting a check here on what's happening in the Florida races as well, given kind of what this means for the Republican Party composition in Congress.
Yeah, in the Panhandle, one of the special House races that is happening today to fill the seat vacated by former Congressman Matt Gaetz, it is expected the Republican is going to win. That's not really the one to watch. The one to watch is in the 6th District in the Daytona Beach area. This is the seat that was vacated by Mike Waltz, who is now the National Security Advisor. He won that seat by more than 30 points in November, and this was also a plus 30 district for Donald Trump in November. But the Republican candidate, Randy Fine, in this case, is not putting up those kind of numbers in the polls leading up to the vote today. In fact, there is speculation that he could end up within single digits of his Democratic challenger. This is not the kind of performance Republicans were really hoping for. In part, strategists I've talked to have said that this is maybe a question around candidate quality, and Randy Fine assuming that this safely Republican district was going to be an easy one to win, as he hasn't fundraised as much as the Democrat. But the other factor that is at play here is whether or not this is going to be a race that could be a tell as to whether voters are satisfied with the policies coming from the Trump administration, not just in regard to things like tariffs and the economy, but also the efforts of the Department of Government Efficiency. Democrats are pinning the race today in Florida, as well as the Supreme Court election that's happening in Wisconsin today, as in part being referendums on Elon Musk himself, who, of course, in the case of Wisconsin, has been incredibly financially active.
All right, Kayleigh Lines, it's great to see you. That is Kayleigh Lines. Tune in to Balance of Power for special coverage of President Trump's Rose Garden announcement on tariffs. Guests for today's special include former USTR Katherine Tai. Balance of Power will have extended programming today and tomorrow from 5 to 7 p.m. New York time. But I want to go to these markets right now because we've erased our losses. We were down as much as 0.5%, but you can see that we've fought our way back to positive territory. Big tech is leading the way, and you can see that in the S&P 500 because you have 324 names that are in the red right now. But then you have Tesla, Microsoft, Meta, Alphabet, Amazon, all pushing to the upside. And I want to take a look at the VIX right now because we know that it's been a choppy market. You have the VIX a little bit lower today, but I wanted to show this 1 year, you guys, because we're trading with a 22 handle. The average is below 17 when you blow it back a year. So clearly there's a lot of volatility in this market, and that leads us nicely to the big day tomorrow.
Yeah, and I have a little public service announcement. For those of you with Bloomberg Terminal, you can type WSL Politics, and that will pull up for you basically a spreadsheet of the tariffs that the U.S. charges other countries and the amount we import from them. I think it's pretty fascinating that you see China, Vietnam, and India all there at the top, but Italy the most among the European countries. Tomorrow on Open Interest, Nimrit Kong joins us of North Star Asset Management.